Welcome. Today we're going to be covering producer costs. This is based on Chapter 7 of the textbook. We're going to start with just an overview of the distinction between economic and accounting costs. And then from there, we'll move on to sunk costs in the next video, followed by a discussion of the firm expansion path in both the short and long run. From there, we'll go into a discussion of firms' short run and long run total cost curves, which will be followed by drawing the distinction between total costs, fixed costs, and variable costs. We'll explore each of those in detail. And then we'll look at average costs compared to marginal costs, and ultimately the firm shutdown decision towards the end of our chapter. And then we'll finish with economies of scale and economies of scope. So that's a overview for all of the videos in this lecture series. This first one, we're going to be focusing on economic and accounting costs. So to give you a broad overview of how we're going to be thinking about costs, excuse me, we are moving from the producer behavior model. So we're continuing to think about how we answer the question of how firms optimize. We're thinking about, again, how do they decide how much to produce? How do producers respond to changes in market conditions? And whether to switch which product they produce or enter or exit or shut down in a market. So first we need to draw this distinction between producer costs, excuse me, not producer costs, economic costs and accounting costs. With our economic costs, we're thinking about the total sum of all the costs that a producer faces. So that's not only the direct cost of operating a business, but also the opportunity costs of the inputs they use, as well as the product that they produce. So when we're talking about economic costs, we're really focusing in on those opportunity costs. Another way you can think about accounting costs is as cash flow. So what cash is a business putting out and what cash is it bringing in? Whereas again, economic costs is really focused on opportunity costs. What is the value of what they're giving up when they use a specific amount of labor or capital, as well as what do they give up when they produce one good over another? For example, if a farmer can produce soybeans or corn, what do they give up by using more tractors and fewer farm hands? Right? Or what do they give up by producing corn instead of soybeans? Right? That's what we're thinking about here. So opportunity costs are going to be all of those production costs that are relevant for the firm. You could even add in the word marginal in between opportunity and cost there. It's, excuse me, not between those two. It should be in front of opportunity. So marginal opportunity costs, we're thinking on the margin here. So when the firm when a farmer purchases another tractor, what are they giving up in terms of the labor they could use, right? Or vice versa. Accounting costs, excuse me, in contrast, do not account for these opportunity costs. Right? Again, it's only that cash flow in and out that the accounting costs are considering. Right? It's whatever's on the book. So importantly, right, how we're going to think about costs in this class is going to be different than you're likely going to see it in your accounting class. Right? We're not just thinking about what the price of the goods are relative to our revenue, but we're also thinking about what the producer could have done instead. Okay, so to put it in more mathematical terms, accounting profit is total revenue minus total accounting costs, whereas economic profit is total revenue minus total costs, so total opportunity costs and total accounting costs. All right, so here we're defining profit along with this consideration of opportunity costs. All right, so here's an example for you. So we have entrepreneur, right, kind of like entrepreneur. And Anne currently works as a law clerk for $30,000 a year. She also owns a building that she rents to a business for $6,000 a year. And she also has $23,000 deposited in something like a mutual fund. She's invested it and she's earning a 10% interest on that money. Anne has this dream of pursuing that she's considering pursuing where she owns and operates a pizzeria. Let's say that this year she decides to do that. She says, you know what, I'm done being a law clerk. I'm going to start my pizzeria. The time has come. She puts out an ad and hires one employee besides herself. She kicks the business out that she was renting her building to and uses that to house her pizzeria. And she also cashes out her $23,000 deposit to finance her business, and then borrows an additional $20,000 along with that, with a 10% interest on that loan to help her pay for that employee as well as all necessary equipment. Right. And with this endeavor, there's no guarantee she'll succeed, right? It could be that actually she should have stayed in her law clerk job the whole time, and that this pizzeria experiment was just going to be a waste of her time, right? The way that we're going to evaluate that is by looking at the economic profit that she earns. So we might consider that, for example, in her first year of operating her pizzeria, she earns $85,000. Right. So what we want to know is this revenue compared to her total costs, right? What is her economic profit now? All right. So we'll look at this. So on the slide, I've shown you both her accounting profit and her economic profit so we can compare the two. So for her accounting profit, we take her total revenue, which is 85,000, and we subtract from that her total explicit cost. So what is she actually spending on running this pizzeria? So she spent 13,000 on equipment, 30,000 on an employee that she pays, as well as $2,000 on of interest on the $20,000 loan she took out. This leaves her with $40,000 in positive accounting profit at the end of that calculation. If we look instead to her economic profit, right now we're going to look at those total costs, which will be the explicit costs that we looked at previously, as well as her opportunity costs. Okay. So her explicit costs are what we outlined previously for the accounting profit: 13,000 on equipment, 30,000 on an employee, and $2,000 of payment for a loan. So for those explicit costs, those add up to 45,000. Now we also want to consider her opportunity costs. So by working to run this pizzeria, she's given up $30,000. That was her previous salary as a law clerk. She's also foregone the $6,000 she was getting each year for renting out her building. And then finally, she's foregone the $2,300 of interest that she had on her deposited money, right? She pulled out that money to fund her start up her business, so she's no longer earning those dividends. So adding those to our explicit costs, we get $45,000 in explicit costs and $38,300 in opportunity costs or implicit costs. And that's going to leave us with a much smaller positive sum of $1,700. Right? When it comes to whether or not Anne's pursuing of her dream of a pizzeria, owning and operating a pizzeria, when we evaluate whether that was a good decision or not, we're really just looking at the sign of that economic profit. So obviously Anne is going to want that number to be bigger, but for our purposes, what really matters is that it's just greater than 0, right? So that means that Anne has made a proper judgment. She's exercised entrepreneurship and noticed that her work and those resources were going to be more valuable in the operation of a pizzeria than how they were previously being used, right? So that's what that economic profit signals. It signals that those resources have in fact been moved from a less valued use to a higher valued use. Okay. If her total revenue was instead something like 50,000, then her total economic profit is going to be very negative, right? So we can say economic profit would be very negative. And that would signal to Anne in that case that her judgment was incorrect. Actually, her labor and the use of those other resources is more valued in their original uses than operating her pizzeria. Okay. With that, we'll pause this video here, and the next one will pick up covering sunk costs.